In this video, we're gonna break down startup funding rounds and what they mean, because honestly, it's not the most intuitive of concepts. The convention to name a round seed versus a Series A or a Series B or Series C responds mostly to the company's stage and a little bit to the size of the round. A lot of the confusion here comes from the fact that rounds can vary in size a lot. You can find seed rounds at $250,000 and at $2 million, and they are both true seed rounds, or at least that's how they report them on Crunchbase. So let's get to it. So the first thing that you need to understand is the type of company that raises venture capital, because only a handful of companies have access to that type of capital. The reason I know any of this is because we are a venture-backed company ourselves. I also spoke to a couple of founders of Series B or Series C-backed companies, and most importantly, because of what we do. We help companies navigate this mess. That's a shameless plug. But anyway, venture capital normally comes in when a company has the ability to scale massively. I'm talking tripling their revenue year on year for a few years and getting into hundreds of millions of dollars in annual revenue. And not all companies can achieve that. In fact, only a handful can. A marketing agency, a consulting company, a dev shop, a blog, a YouTube channel. Most e-commerce platforms don't really qualify as venture-backable companies just because they can't usually afford to grow that fast. In this day and age, venture capitalists aren't looking for an e-commerce shop. They're looking for companies like Shopify, where millions of online shops live. They're looking for transformative companies that are using technology to disrupt how millions of people or thousands of companies do things. We made a whole video about this gap between what we call startup versus small business, the venture-backable and the one that can't be venture-backed. I'll link it if you want to watch that. Both of these companies have access to capital, but it's different capital, it's different investors. This Series A, B, C alphabet is most commonly used for the second type of company, the fast-growing startup. And the only reason why we qualified to raise money as that is because we're a SaaS product. Our YouTube channel or our design consulting branches, they're not venture-backable businesses themselves. Okay, so disclaimers aside, let's go through the stages of one of these fast-growing startups. The first thing that you need to understand here is that a round should provide enough capital to reach the next round. That's a very common mistake founders make. They raise money without actually running the math to confirm that what they're doing, where they're spending their money, is enough to reach their next fundable milestone. So let's start talking about pre-seed. Let's run a scenario. A few guys got together, a couple of product people, maybe a dude with some marketing skills, and they figured that they would start a company. And maybe this is a B2B SaaS platform. The first thing that they need to do is raise some money to get started, right? No. That's wrong. That's the wrong approach. The first thing that they need to do is figure out if their product, or whatever they're going to build, makes sense, and if there's a market for it. And you don't really need that much money for that, or any money at all. You don't need a product for that. Before building anything, there's a phase of asking questions, of talking to people. There's a phase of building a fake landing page and pushing people there to seeing how they react, which we actually did ourselves. You can do all of this without any investor capital, maybe some savings, maybe keeping your day job. But if you were to raise money at this stage, we would call this a pre-seed round. This is the earliest capital a company can raise. So pre-seed rounds are normally used to build a first product prototype, but not necessarily to launch it. This prototype might be enough to maybe get some customers, but the idea is that this prototype should unlock the door, give you the key to go out and raise more capital, to go out and raise a seed round and actually begin growing aggressively. Pre-seed rounds are normally under $500,000 and are normally raised from friends and family investors because there is no product. All you are going with is a pitch deck, an idea, and your team's reputation. That means that going out to strangers for this capital is unlikely to yield success because they just don't know who you are. Now, seed rounds are used to begin growing the product. The assumption here is that the product is ready or almost ready, and that the seed round should suffice to get the company to the next stage, which in this case is a Series A. That's very important about any round, and so often overlooked by founders. Founders often raise money to either launch the product or get a random arbitrary number of customers, or maybe 18 months of runway. A round needs to be enough to put the company in a position to raise the next one, period. I've said it like 3 times now. Anyway, it's not profitability, it's not the 18 months, it's the position to the next round. Timing is also very important, by the way. The money does need to last for at least 12 months so that you're not immediately back fundraising just a couple months after closing the previous funding. Fundraising is very distracting. It stops the CEO from doing their job, which is essentially growing the company. But the next fundable milestone after a seed round is a Series A. So let's understand what's required for that. The benchmark for a Series A round varies from industry to industry, and it varies depending honestly on the fundraising landscape. But in our case, let's talk about our example, which is software as a service. It's usually around $1.5 million in ARR, maybe $2 million. That's about $125,000 to $180,000 in monthly subscriptions. And that, of course, comes with other variables: a good understanding of what the company did to get there, signs that there's a good product market fit where customers love the product, where usage is high and churn is low. Another variable is how fast the company is growing at the time. A company that took 3 years to get from 0 to 1.5 million ARR with funding is very different from a company that took 12 months to achieve it, or from a company that bootstrapped it. Momentum is very important. Fewer than half of seed-funded companies make it to Series A. And the size of a round varies a lot. I've seen rounds as small as $2 million and as big as $15 million. The average Series A for 2020 was $15.6 million. And this is where things get a little confusing, of course, because if a company raises $2 million, is that a seed or is it a Series A? Remember, it's not about the money. It's much more about the company stage and the time of the raise. Starting at this stage, funding rounds are very much tied to an anchor or a brand name VC. So if you're raising $10 million, you're not going to want to go find dozens of angel investors for that. Companies at this stage are looking for a venture capital firm that can lead the round. The anchor or the lead takes care of the diligence, negotiates the deal, provides credibility to the whole thing, to the company, and for other investors to follow suit. And there are a lot of angel and venture firms who will tell you that they don't lead rounds. They just follow rounds. And it's honestly a smart investment strategy because they just have somebody else do all the hard work. By the way, crowdfunding is another option here once you've got a lead investor. Maybe the lead committed $5 million and you need to fill in the other 5 using other investors. We made a whole video about that, by the way. More on Series A. Since we're dealing with bigger numbers, investors want more oversight of their money. It's very common for investors at this stage to negotiate either a board seat and or preferred stock and or other investor protection mechanisms. After Series A, things, of course, will get a lot more serious. You're still a startup, yes, but you're at a stage where you should be making millions of dollars a year. You have clearly identified market and you are ready to take over. So here's Pete Sullivan, who's the CEO of a company called Jackpocket. If you're in New York, you've probably seen them. And he's talking about what happened with their Series A. Just for context, their company has this iOS app that sells lottery.
And we had gotten New York, and at this time, New Jersey, to say, okay, we're gonna do regulation. So I think investors were opportunistic that this was finally gonna come to fruition at some point, that they had to kind of pay to, get in early. But at the same time, we were able to launch 2 smaller states, and we're approaching a launch in Texas, which was a huge state for us. And so at that point, our revenue is a percentage of the amount of ticket sales, but I think we were at that point showcasing enough that investors could extrapolate, hey, if they continue to add states and we continue to add marketing, we're going to see this thing continue to grow. And so the points that I think we had proven out by then were that the cost of acquisition and the average spend, so LTV to CAC ratio, was getting into a place that the product would be viable long term. Now we needed to scale that, and Texas was that first opportunity that allowed us to scale. And it was funny, the B was very oversubscribed because at that point, again, we now had momentum that something was going to happen in New York. We had momentum that something was happening in New Jersey, and we had shown that we can get into other states.
Okay, so before we go into Series B, I want to talk about a limbo. What happens if you don't get to where you're going? Say you have raised a Series A. You have investors and you have $10 million invested in your business, but the company just didn't manage to grow that fast. That is a bad, tight spot to be in if you're a venture-backed company, because it's a lot of money from investors that's stuck because your last valuation was maybe $20, $30 million. So the only way they can get that money out if you're growing slow is an acquisition that makes sense and that pays them back on their investment. So you can see a fair share of cases like this. You can just search for Series A funded companies that haven't raised in maybe 3 or 4 years. They're probably in that limbo. Another common limbo happens between seed and Series A. A company that raised maybe $1 or $2 million but has not reached the momentum or the size needed for a Series A. This actually happened to us. I told that story in a couple of videos on how churn was probably the culprit for all this, so I'll also link that. Anyway, the name post-seed comes from this, if you ever hear it. A seed company that's not yet Series A stage. And for the most part, post-seed rounds aren't great deals. These are companies that don't have a lot of leverage to negotiate the terms of that round, and it's kind of like a bridge to maybe make it to Series A. But that's not what this video is about. I can make another one discussing some more examples of these limbo cases and how companies have gotten out of them. But let's get back to the Alphabet stuff. So Series B. If things go as planned, you are on your way to a Series B, preparing to take over. What is taking over? Well, this means a lot of expensive things. That means branding, marketing, a much more experienced team, probably coming from other startups. And that takes money. So according to Investopedia, the average Series B is $33 million. However, that amount, the goals and the use of funds of a Series B can really vary a lot. For example, we helped the guys from Upkeep. We wrote and designed the deck that they used to raise their Series B. And they ended up raising about $36 million. And most of the time that we spent on that pitch deck was on metrics. It was proving to investors that they understood everything about their customers and how those numbers would scale. I also spoke to Eric Johnson from Membercy. So they raised a $20 million Series A as debt, not equity, which is another explanation itself I can do later. But for the Series B, they raised $66 million.
Tell me a little bit about it. Tell me a little bit about the expectations. What do investors expect will happen 18 months or 24 months after this round closed?
Yeah, so, for us, it's a unique situation because we've actually been profitable for many years, even when I had that high interest debt payment, right? And we, last year, close to $7-8 million in EBITDA, right? So, we've always been a cash flow heavy business. So for us, it's not necessarily about losing money right now, right? It's more so about, right, reinvesting any profits we have, right? And giving ourselves a little bit, more cushion to do so, right? This is a true kind of in all shapes and, this is a growth investment, which is cool. It's not hey, the investors are looking for dividend returns, right, in the next, 3 years, or the investors are looking to just do nothing but, go buy companies, right? It's an organic growth story, and we're going to be, opportunistic in any M&A activity that makes sense, but this is a growth play all about. Now, when you're going through a round like that, right, you really have to lay out, you have a very detailed model, right? A very detailed, typically a 5-year model is going to go into kind of a base, best, and worst case scenario for the future, and then you have to sell the investors on that model and have them understand that model. So that's where your banker really comes in and helps you out with that. And then once you have a model, right, that is tested, typically, they'll discount that model right away, on their end, usually 20%.
So financial models and a detailed understanding of those numbers became a common theme with everybody I spoke to. It seems that what you need to accomplish with a Series B looking to raise a Series C is just this incredibly detailed understanding of your financials and your projections. It's certainty, or something close to that your company can scale a lot more. So these rounds happen on hard data, never on ideas, not on unknown expectations. Capital may come from VCs, maybe from hedge funds, private equity firms, because you're essentially dealing with a large company and a proven business model. Some of that funding may also connect to acquisitions. A company at this stage can begin absorbing competitors or other strategic deals like that. So a lot of things can happen after Series C. These days, you can see companies staying private, with Series going all the way to E and F. Alternatively, they can begin a push to an IPO, which can provide investors with their much desired ROI out of these investments. We made a couple videos that will be useful here, a video explaining the entire process of going public, which I will also link in the description, and then a video kind of going through the journey of a startup, raising money from seed, going through vesting periods and the founders quitting, and finally going through an acquisition and how much money they made. So it's this 4-video series. I'll also link that. But just to do a summary of everything we've covered. Pre-seed rounds are for pre-product companies. They're mostly for friends and family investors and usually under 500K. Seed rounds, they need to be enough to get to a Series A and should be invested mostly in growth. They should give the company momentum to get on a track of growth. Series A rounds, again, enough to reach a Series B. Focus on understanding the customer and proving unquestionably that this product works for them. Also in Series A, you're beginning to build a solid, proven team. For Series B and Series C rounds and anything after, this is just scale. It's focused on detailed financials, strategic partnerships or acquisition, but anything that drives you to this world domination. Hope that all was useful, guys. See you next week.